that. Sandeep, hi, good morning. Great to have you on the show. Sandeep, while the Fed has moved at par with expectations, tell me, what does it really translate into whether or not we're going to see any material discretionary spends go up?
Hi, good morning, and thanks for having me on the show. So I'm traveling, so you may see some background, but yeah, Fed has cut the rate, and yeah, also more than that, they have done some bit on the liquidity front. So and also I think the most important thing is the comment that no rate hike coming. So I think lot of uncertainty has been taken off, although the cut may not be what is not going to give much relief, but the commentary is quite good in my view. So I think the confusion which was there in a lot of companies where they were thinking how to deal with the discretionary part of their tech budget, that clarity comes. So it is a situation which is better than earlier. But having said so, the real challenge is the effort cut which will happen with AI rollouts, because now most of the capex part is mainstream, and that's the reason you have seen the benefits flowing into the kinds of Nvidia, AMD, and other hardware players. And now that that services will have to start playing out, and when they start playing out, definitely you will see two things happening. One, new projects, new contracts coming in, and at the same time cannibalizing of the existing one, and redefining the efforts of the existing one. So there'll be some decline in the efforts, and there'll be some new business. I would say that if Indian IT companies will be the only one probably who will be able to manage that decline and be flattish for next 12 months in terms of growth, or maybe growth. Others may have even more severe challenges given the disruption which is happening due to AI.
And Sandeep, hi, good morning. Give us a sense on what this means from an FY26 or an FY27 standpoint. You will likely see another 25 bips of cut at the very least in 2026 calendar year. So what does that mean for FY27 earnings? Can we expect a significant uptick? Will we go mid-single to higher single-digit uptick, especially for the large IT companies? Is that at all possible, or just there's no scope for that despite the rate cuts?
No, so FY26, I don't have very high hopes, primarily because we are into a quarter like December where there's less number of working days due to the Christmas holidays and other things. So manufacturing goes on furloughs. So whatever you do, you can't grow unless there is some exception environment. So in last 20-25 years, only one quarter was there in 1 year when Infosys posted a very robust growth in December quarter, but that is very, very difficult. So I don't see much growth here in the current quarter. Also in the March quarter, because of less number of days in the month of February, it is little difficult to give a positive surprise. Having said so, if more rate cuts are anticipated, then what happens is the client budgets will be slightly better than what they were earlier, and that communication happens around 15th of January to 20th of January. And so these companies, when they come out with results, the commentary may be a little optimistic than what it was earlier. Having on the growth side, I think the large cap mid single digit growth, 6-7% kind of growth, I don't think there is a big challenge in that. But for 6-7% growth, our contention is that the valuations are little high. Similarly, for the mid caps, 10-12% growth is not a big challenge. But for that, again, the multiples which they are trading at 30 times is little high. And similarly, some of the specialized er&d players where growth could be 15-17%, the multiples are upwards of 40 times. So that is the only challenge. So it is a mismatch of multiples and growth. Otherwise, it is a cash-rich sector. There is no problem on the working capital, no capex. So on all fronts, otherwise, it is a very good sector to win. But growth, it is now kind of low growth sector, matured sector.
Sandeep, lastly, have to talk about TCS's acquisition of Coastal Cloud. How do you think it ties in with now the data center capabilities that they're building up?
No, so it is a fantastic thing for all the large IT companies to diversify their skill set requirement and fill their skill set gaps. So if you see TCS with this acquisition of almost like it is an all cash deal. I think it is a 5-time trailing 12-month revenue. I think the good thing is that you are paying for the specialists which are coming in. Some people debate that in IT services industry why you have to for acquisition, because finally you are acquiring manpower. So we have a different view. I think that the market cap is also because of the manpower business. So you have to give value to the manpower, even if it is a soft value. So I think this skill set addition is going to be very good. And I think most of the tech companies you will see next 1 or 2 years, they will very aggressively acquire small skill set based players. And they are now come down a little bit in the valuation because they have also suffered due to this cut in efforts of AI, and the valuations have come off a bit, so they are now easily available. So I think it will be much more acquisitions will happen, small size in next 12 to 18 months, and that will fill the gap of AI skill set for most of the companies, which is good from long term perspective. So the only thing is that the reset of base has to happen, which takes another 12 months in my view. After that, you will again see this industry numbers slightly better than what you have seen in last 2 years.